This conference will now be recorded.
Good afternoon, everyone, and I hope you had an enjoyable summer. The purpose of our session today is to have an overview of the accounting cycle in preparation for the beginning of class. The accounting cycle, and let me begin to share my screen. And as we begin to look at accounting, you notice this picture of an entrepreneur. And this is the mindset that you've got to understand accounting, that your goal is to move from being a consumer of goods to starting a business with a profit motive. So that's the focus that we want to have. So you should be thinking about, okay, if I'm going to start a business, what do I need to do? You need to develop a business plan, determine what type of business you're going to have, and make sure you have appropriate resources to begin the business. Typically, you're going to form a corporation, and that limits your liability. So we're looking at forming a corporation so we aren't personally liable for our debts. So how do we start this corporation so that we can make money? We first of all select the corporate name. Then we draft and file articles of incorporation. Then we create an organizational chart. Who's going to be the president? Who's on the board? We obtain an employee identification number. This is the federal ID number. We maintain corporate minutes, and we issue shares of stock. Very important. When you form a corporation and you put your cash in, the corporation is a separate entity from you. You no longer own the cash, the corporations own it, and your ownership is represented by a stock certificate. And so this reflects then what you your interest in your corporation and the money that you have.
This conference will now be recorded.
And so with that perspective, the final thing that we do is we create an accounting system that will prepare those financial statements. Remember, we talked about in the theoretical framework that the purpose of accounting is to learn how to prepare for financial statements: income statement, statement of retained earnings, balance sheet, and statement of cash flow. So in this chapter, we have an accounting cycle which leads us into the preparation of these statements. And this is what your business is going to utilize to reflect how it is doing. The income statement, or the revenues and expenses. Statement of retained earnings, how many earnings were retained in the business. The balance sheet at a particular point in time, what are the assets, liabilities, stockholders' equities. And then the statement of cash flows, what was the sources and uses of cash during the period. So when you operate your business, and all corporations do this, they summarize all of their transactions into these 4 financial statements. So let's look now, as we focus on accounting, the accounting equation: assets equal liabilities plus stockholders' equity. Stockholders' equity is common stock plus retained earnings. Retained earnings is revenue minus expenses minus dividends. So this is the fundamental accounting equation that governs how we're going to record our transactions and prepare those financial statements. This is that fundamental equation: assets equal liabilities plus common stock plus retained earnings. When we start a business, we put cash in. So we would put the cash in, 100,000. We would receive a stock certificate saying that we put $100,000 in the company, and the stock certificate will reflect that. The purpose of the business is twofold. First of all, we want to increase cash. Secondly, we want to increase that cash through the earnings that are retained in the business. That's the purpose of accounting, to determine, given that we started a business with so much money, 100,000, how much should the cash go up, and other assets, change the liabilities, and importantly, how much were the earnings. If the cash doesn't go up and the earnings don't go up, why did we start the business? Let's talk about the double entry system of business, and this was discovered by Luca Pacioli in the 1400s. And what he said was that in any transaction, you receive something and you give something. So it's a balancing thing, that when you get something, when you receive something, you got to give up something. So in a business transaction between two business persons, you receive something and you give something. Then he created a T account, and he said on the left side is the debit in terms of what we receive, and on the right side is the credit. So you can see that, two things are happening. We're receiving something and we're giving something up. And we're going to find that what we receive goes in one T account, what we give up goes in the other T account. So in the double entry system, as we go back to our accounting equation, asset equal liabilities plus common stock plus retained earnings plus revenues minus dividends and expenses, we're going to say that the debits, which are on the left side, is always going to give the credits on the right side, though the expenses and dividends will be debits also. So we will subtract them on the side. So the big thing in accounting, returning to that accounting equation, assets equal liabilities plus common stock plus retained earnings plus revenues minus expenses and dividends. The debits, the things that we receive, equal the credits that we gave up for liabilities, common stock when we formed the corporation, earnings that come in, and we hope this is a plus. If it's a negative, that means you lost money. Credits for the revenues that came in, and then debits for the expenses that are on the side. So the assets always are going to be equal to the right side of that equation, the liabilities, common stock, and retained earnings. Retained earnings, of course, is summarized by revenues minus expenses and dividends. So we'll come back to this, just introducing you to the overall concept of how accounting operates. We have an equation, and in this equation, we reflect for these items, what did we receive of value and what did we give up. Let's look at a reason why we use debits and credits. Suppose I gave you these transactions here and say how much cash we got. You had a cash increase, then you had a decrease, increase, decrease, increase, decrease, increase, decrease. So the increase of pluses, the decrease of minuses, how much cash you got? We could go step by step to do it this way, but if we look at what we actually do, whenever there's an increase, it's a debit and we're putting it on the left side. When there's a decrease, it's a credit, we're putting it on the right side. We then add up our debits, we add up our credits, and we get the balance that way. So it's easier to get the balance by adding up all the debits and credits and taking the difference than to go item by item. So that's where the T account comes in that was formed here in terms of keeping track of the balances in the accounts. So we have double entry accounting, where we reflect the fact that for all transactions, there are two parts. We receive something of value and we give something of value. What we receive of value is the debit. What we give of value is the credit. So suppose you buy an auto paying $10,000 in cash. You're going to debit the auto for $10,000 because you receive something of value, $10,000. We're going to credit cash for $10,000 because we gave up something of value. Now, if we bought the auto using debt only, we'd have a debit to the auto for 10. That's what we got in value. We'd have a credit to notes payable because we now owe something. Then we have the situation where we buy an auto, we pay $2,000 down, and we sign a note for the balance. We still have an auto for $10,000. We gave up $2,000 down. Then we also gave up a note because we got to pay now the borrower, the person we borrowed from, this $8,000. So this is always what's happening in accounting that we have to reflect. What do we get and what do we give up to get it as we're engaging in business transaction? With the end result, at the end of the day, we want to make sure that our cash went up and we made a profit during the period. That's our goal. So let's look at the accounting cycle that is going to help us prepare those four financial statements: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flow. First, we analyze transactions, all the financial transactions. Then we make journal entries, steps 1 and 2. And that's all we're going to look at in this lecture. And that's all we're going to look at the first week. Because if you don't get steps 1 and 2, especially 2, make the journal entry right, then you can't do these steps here because they follow these steps. So we're going to post to the ledger, prepare the trial balance, make adjustment entry, adjust the trial balance. We're going to prepare financial statements. We're going to close accounts. We're going to do a post-closing trial balance. We're going to do all of that. But for this first week, we're simply learning how to do steps 1 and 2. And we have to learn steps 1 and 2 because that's how we learn accounting. That's the most difficult step, and we can't go any further. And so, once again, we said we're just doing the first 2 steps. Step 1, making journal entries. Every time there's a financial transaction, it's recorded. All companies do this recording. They do it with journal entries. Each journal entry requires an equal debit and credit amount. So at the end of the day, the debits equal the credits. We read the financial transaction, determine what type of journal entry is required for the transaction from the types that are going to be listed below. Now, the impact of a debit or a credit on accounts is summarized below. For assets, debits will increase it, credits will decrease it. The normal balance we want on an asset is a debit. For contra accounts, we'll talk about those later, but it's credit, debit, credit. Liabilities, they're increased by credits, they're reduced by debits. Normal balance is a credit. Common stock is increased by credit, it's decreased by debit, but its normal balance is going to be a credit. Retained earnings is increased by credits, it's reduced by debits. If its balance is a credit, that means we've earned money. If it's a debit, then we lost money. Revenues, in this course, they're only going to have credits, which increase it, and the balance is a credit. So for revenues, we only credit those accounts. For expenses and dividends, they have debit balances, debit transactions only, and we're only going to debit the account. Summarizing again, a debit entry increases assets and increases expenses. It reduces capital and liabilities. Credit interest is going to operate just the opposite. They're going to decrease assets. They're going to decrease expenses, increase capital, increase liabilities. Okay. So once again, we're simply working on how to make a journal entry, the first two steps in the process. And what I've done is created transaction types. So in this course, there are 20 transactions that we will work with. But as we start the course, we're only going to work with about 9 of these transactions. The only ones you got to worry about are transactions. You can check these off: 1, 2, and 3, 7, 8, 9, and 10, 12, and 15. So in this chapter, those are all of the transactions that we're working with. And so the first 6 transactions involve cash increases or receipts of cash. So there's 6 types of transactions. Whenever we're dealing with transaction 1 through 6, cash is going to be debited. That's what we receive of value. And we're going to credit what we gave up. When we formed the corporation, we issued cash. We received cash. So we debit cash. We're going to credit common stock. So this is saying if it's type 1 transaction, we debit cash and we credit common stock. If we receive some revenue in cash, we debit cash and we credit revenue, sales, or fees. It doesn't matter. It can be revenue, it can be sales or fees. The third situation involving cash, it occurs when we collect cash. When we made a sale earlier. So we've done some work for someone, they pay us later. We're going to debit cash and we're going to credit account receivable. So transactions 1, 2, and 3, when cash comes in, that's all we're dealing with on the cash increases. Let's go to cash decreases, and we're going to only be dealing with 7 through 10. That's all you got to worry about. If we purchase an asset, whether we receive a valued asset, we debit it, whether we give up cash. So in this next set, we're paying out cash. So cash is credited. See, that's different. When cash comes in, we debit it. When cash goes out, we credit it. Payment of a liability, whether we receive a value, the liability is paid. Whether we're going to credit, whether we give up cash. If we pay an expense, whether we receive a value, an expense was paid. Our rent was paid, our utilities, whether we give up cash. Finally, dividends. Dividends are what we pay the owners. When you own stock in the company, the way you are paid for that is that a dividend is paid to you. It's not an expense because it's a return to the owner based on what you invested. So what does the corporation give up a value dividend to its shareholders? What does it receive a dividend? The shareholders was given up cash. Those are all the transactions on the cash side. So when we analyze a transaction, did cash go up? It's got to be 1, 2, or 3, and we tell you what you debit, what you credit. If it's a decrease, we have to debit one of these items and we credit cash. Next, we have a purchase of an asset utilizing debt. So if you utilize debt and you purchase an asset, it's transaction 12. What account, whether we receive a value in assets or whatever asset we receive, we debit it. And then for the liability that was created, we credit it. The other one involves sales on account. Sales on account reflect the fact that, okay, you sell something, but you don't get the cash right away. And so I simply debit account receivable and I credit sales revenue or fees, whatever my business is utilizing. And a lot of businesses operate this way. They sell an item, they don't get the cash right away, but they get a receivable. So that's good. They just collect the cash later. And once we have a 15 transaction, we can go back up here to 3. When we get the cash, a 3 occurs. So we can't have a 3 unless we've had a prior 15 where we had that sale on account. Those are all of the transactions. Those are all of the transactions that we're going to be working with this period. So you just got to learn those transactions. Let's look at our chart of accounts. When you have a transaction, you got to pick one of these accounts with a number. So assets, cash, receivables, these are accounts that you're going to pick up. Got normal balances. You aren't overly concerned about that, but this tells you the account that you got to use. For a loan, so these are current assets, items that are going to convert to cash in a year or be utilized in a year. Then for the long-term assets, they last longer than a year. They're here. So when you record a transaction, you always got to pick one of these accounts. Here are the liabilities. Accounts payable, short-term, undocumented asset, none note. If we have a note involved for large purchases, then it's called a note or mortgage payable. Here's common stock, here's additional paid-in capital. Here's retained earnings, here's dividends. These are assets to the balance sheet accounts. Then we have the revenues and expenses. We have sales. We have cost of goods sold, which we'll get to eventually. Then we have advertising, all the costs and expenses. And so the normal balance is debit. And we said in the course for revenue, which is the credit. Now, if you have returns, that's going to be a debit. But regular revenue, sales, expenses are credits. And the expenses basically just have debit amounts. Okay. So all journal entries require debits and credits to at least 2 of those accounts. The trial balance, and we get to this, got to be prepared exactly like this, so we keep things in order. And we'll talk about some other aspects, but we just want to look at that. So what we want to do for the rest of this session now is to illustrate the recording of journal entries. This is the first thing you've got to do. We might have a quiz on this next class period, a mini quiz on this, recording journal entries. So we have a transaction, we have to analyze it, and then we record the transactions. So I'm going through the first, these first 10, which is going to be an example of those 10 journal entries we have to deal with. So you just have to determine which one that we're dealing with. So let's look at transaction 1, where we invested $100,000 in the business. Okay, what type of transaction is that? We go up here and say, okay, issue the common stock invested in the business. This is a type 1. What's debited cash? What's credited common stock? And that's all we're dealing with now. So as we go back down here and record this transaction, we're going to debit cash and credit common stock. And notice what we do. We go to the chart of accounts. Cash is number is 100. So we're going to debit cash for 100. That put the account number 100 down and put the 10,000 in cash down. Then we're going to credit common stocks. We're going to go to common stock. Common stocks number is 400. So we're going to credit common stock for 400,000. We'll receive a value 10,000. We give up 10,000. The transaction transaction type is type 1. So when you make a journal entry, I want you to do all of this. So you have an example of the first journal entry. We put the account numbers down, we put the account names down, we put the dollar amounts down, and we put the type. In actuality, in business, you're just going to be working with those account numbers, but we got you working with both now. Let's look at our second transaction, cash revenue received for car rental revenue. So we got a rental company and we received $50,000 in revenue. What type of transaction is that? That is type 2, where the cash received for revenues issued, for revenues earned. Okay, we go to the account, cash again, but our credit is going to be the 500 sales. So we make the journal entry, we debit cash and credit sales. Account number 100 and 500 now. Receive a value, 50,000, pay the value, and the type is transaction 2. Next, we collected cash on account from corporate customers, 20,000. So that means that, we had to sell to customers on account, and we'll get to that transaction later. We're just keeping it in order, but this would occur after 10. So we collected 10,000 from corporate customers. Once again, we go up here to the type of transaction type. It's a 3. We're going to debit cash. We're going to credit account receivable. Going to our chart of accounts, cash is 100, account receivable is 110. So we debit cash for 20,000, credit account receivable for 20, and we put out type 3. So every business does this. This is all we're doing now. Step 1, analyze the transaction, making the journal entry. That's how we start accounting. Receipt of a short-term working capital loan, 25,000. So let's see what type that is. We're in order. Borrowed some money. We borrowed some money. So that must be transaction type 5. So we're going to debit cash. We're going to credit notes payable. So we come down here. Okay, cash we know is 100. Short-term note payable, so it's 306. So we're going to debit cash and credit short-term note payable, 25,000, because we borrowed some money from the bank to supplement what we have, the $10,000 that we started the business with. And we continue in that format. So these first 4 transactions involve cash receipts, so they have to be transactions 1 through 6. Now we're going to look at the payments for items, and we're going to now begin to look at transaction 6 through 10. We purchase supplies paying 1,000 in cash. So that's going to be transaction 7, where we purchase an asset. Asset purchase supplies, and we credit cash. Now, when we purchase the asset, you're going to tell me what asset it is. So we go to the chart of accounts, and it can be any of these assets. It says the supplies. I know I'm dealing with 130. So I'm going to debit cash, debit supplies 130, credit cash. So now we're giving up something. In this first one, we were getting cash. Now we're giving up cash. We got supplies. That's a type 7. In our next transaction, we paid on accounts payable 5,000. So we bought something on credit. Now we're paying on it. So when we pay on a transaction and we pay a liability, that's going to be a type 8. And so we're going to debit whatever liability it was and credit cash. So it says we paid an account payable. An account payable is 301. So we're going to debit accounts payable 301, and credit cash 100 for 5,000. That's type 8. So I'm just keeping them in order for you. In the next transaction, we paid rent expense of 3,000. What type of transaction is this? Okay, we paid an expense. So this is transaction type 9. We're going to debit the expense and credit cash. So when we're dealing with these transactions, when cash goes out, we debit whatever we pay and we credit cash. Expense paid, it says rent. So we got to go in this chart of accounts and get the rent expense, which is what transaction 6, type 651. So when we get ready to make this journal entry, we debit rent expense and credit cash 3,000, 651, 100, transaction type 9. In our next transaction, we paid dividends of $2,000. Dividends are payments to the owners. That's what we pay the owners. So let's see if we can find the type. Payment of a dividend, that's going to be type 10. What's debited? Dividends. What's credited? Cash. We know cash is 100, but dividends is 455. So the transaction type is telling us the types. The chart of accounts is giving us the exact name of the account and the account number. So we're going to debit dividends and credit cash. 455, 100, type 10. So now we've covered, first of all, 4 transactions that involve the receipt of cash. Then we looked at another 4 that involve the payment of cash. Now we're going to look at 2 transactions. They're financial transaction. We have to record them, but they do not involve cash. They do not involve cash. So we purchase supplies on account. This is like using your credit card. You buy supplies. So you get the asset, but you don't use cash. So that's going to be what? Number 12, purchase of an asset utilizing debt. What we're going to debit, what do we get? Whatever that asset was, what we're going to credit, the liability created. And so in this case, we would get ready to record a type 12 transaction. We got to go and say, okay, what asset did we get? This time we got supplies again, but it was on credit. So the debit is 130. We created an account payable, unsecured short-term notes, like you use your credit card, because eventually you got to pay that credit card. And so that's account number 301. So we're going to debit supplies 130, credit accounts payable 301 for the amount, and that's transaction type 12. And the final transaction that we're looking at, so now you got examples of all of them. We rent cars to corporate customers, and they're going to pay us in the future. And so if I was renting cars to ExxonMobil, I wouldn't have the individuals from ExxonMobil come back and pay me. I would just let the corporate execs have the cars, and I send one bill to ExxonMobil at the end of the month. So in this case, it's $30,000. So the transaction we bill ExxonMobil $30,000. Notice we collect some of that in transaction 3. But when we do the work, we don't have any cash yet. And so we have transaction type 15. We debit account receivable. That's what we got a value. And then we credit sales revenue fees, because that's what we gave up in terms of they used the car. But we like the revenue. We like giving up the car so we can get revenues. We're going to get some cash eventually. So what are our transaction types here? Account receivable, 110. Sales, 500. Those are our account numbers. And so we're going to debit account receivable, 110. We're going to credit sales, account 500 for the 30,000, debit 30,000. That's transaction 15. That's all. So this is all you got to learn how to do to begin to learn account. Every time there's a financial transaction, you got to go here and say, okay, what type of transaction is it? Then that's going to tell you the account will be debited and the account will be credited. But you got to come to this chart of account and get the specific account number. At a bank, you want money in your bank account number, not someone else's. So when you're running a business, each account has a number and it gets into its account the transaction for its type, its number. So each one of these accounts, if you're running a large business, you will utilize a lot of these accounts. These are the accounts we utilize, you don't create any more. Okay. So you got an example of each type of transaction. So next class period, we're going to go through an example. We won't, here we're having it in this order. We're going to go through this example next class period. So go through and review this as much as possible. Make sure you understand everything that we talked about, realizing that when we form a corporation, we have financial transactions. Our goal is to eventually get here and prepare financial statements. But the starting point is to analyze each transaction and make a journal entry. We're spending the first 2 weeks on this so we can make sure you can do that. If you can do that, then you're going to be okay. Thank you.